As interest rates in traditional finance continue to rise, crypto is scraping the barrel in search of competitive, low-risk yields. Enter Coinbase, the largest centralized crypto exchange in the United States. Coinbase users holding the dollar-pegged stablecoin USDC will start earning interest automatically with the option to opt out of the program. Meanwhile, in the world of decentralized finance, Liquity has resurrected protocol-owned Liquidity, a concept that got a lot of hype during the so-called DeFi 2.0 trend last year, but ended up fizzling out. For now, though, it seems to be working, at least for Liquidity. Thanks to Aave Grants DAO for sponsoring this video, more on them later. So this is really the first time that crypto has gone through an economic cycle where global interest rates are rising instead of falling. Remember, Bitcoin was created in 2008 at the start of the financial crisis, which prompted record stimulus and rate cuts. The trend is reversing now, which means that untested DeFi platforms run by anons on Discord are having to compete with tried and true bank deposits. So far, crypto isn't faring very well, with Bitcoin and Ether down about 70% this year, while the total value locked in DeFi has more than halved from its peak of about 170 billion at the end of last year to about 50 billion today. Let's talk about what Coinbase is doing to attract investors and savers first. Its program comes courtesy of MakerDAO, the decentralized autonomous organization behind DAI, a competing stablecoin. On October 24th, MakerDAO voted to allow Coinbase to custody 1.6 billion worth of USDC, on which it will earn a 1.5% yield. That 1.5% yield is passed directly to Coinbase customers who hold their USDC on the platform. But Coinbase's new USDC program comes at a precarious time. The 1.5% yield on offer is lower than savings rates at traditional banks. According to Bankrate, users can earn more than 3% when depositing money into certain TradFi savings accounts. And by choosing bank deposits, users can avoid any smart contract or regulatory risk posed by holding USDC. The question now is whether this can boost demand for the stablecoin. Confidence in USDC appears to be dwindling after the US Treasury Department sanctioned Tornado Cash, a privacy protocol, this summer. In the wake of those sanctions, Circle, the consortium behind USDC, preemptively banned 38 addresses which had interacted with Tornado Cash. Since then, USDC's market capitalization has dropped by 10 billion, even as its two major competitors gained market share. Binance, the world's biggest centralized exchange, also played a part in USDC's recent decline when it converted all of its users' USDC deposits into its own BUSD stablecoin. Check out our Stablecoin Wars video for more info on that. Speaking of regulatory issues, this isn't the first time Coinbase has tried to offer yield on USDC. In June 2021, it teamed up with Compound Labs, the folks behind a DeFi lending protocol of the same name, in a bid to offer users 4% APY on their USDC. At the time, savings rates at banks were woefully low, but things have changed this year after the Fed's aggressive rate hikes. But that project, dubbed Compound Lend, never actually got off the ground due to intervention from the US Securities and Exchange Commission. Before we get to Liquity and its chicken bonds, yes, you heard that right, let's hear from our sponsor. Today's daily sponsor is Aave Grants DAO. Aave's latest deployment, V3, was launched on 6 networks and introduces new features like isolation mode, efficiency mode, and portals. Explore the protocol at aave.com. If you're building in the ecosystem, apply for a grant through aavegrants.org. Now on to Liquity, whose kind of novel chicken bonds program is going better than expected. What are chicken bonds? Well, they're a new product from Liquity that offers users an enhanced yield over a period of time in exchange for bonding Liquity's LUSD stablecoin. In its simplest form, users deposit LUSD, which accrues a balance of boosted LUSD, a derivative token. The bonding happens over time. Users can decide to chicken out and withdraw their principal, or they can decide to chicken in, remain bonded, and claim their principal along with the accrued boosted LUSD at a later date. But it's a complicated decision with multiple factors, including how deep into the bonding process a user is, and what he or she thinks of the future value of boosted LUSD. The yields are highly variable, but can be as high as 150%, according to DeFi Saver. What's the point of all this? Well, when users chicken in, Liquity permanently acquires a portion of the bonded LUSD. It can then deepen liquidity for LUSD on Curve Finance, a decentralized exchange where LUSD is pooled with the USDC, USDT, and DAI stablecoins. More liquidity in the Curve pool means that LUSD can be swapped with minimal price impact for USDC, USDT, and DAI. And this brings us back to Tornado Cash. LUSD is relatively decentralized. Its collateral is Ether rather than the US dollar, for example. Interest in it surged after the sanctions, but that was a double-edged sword. LUSD is always supposed to be worth $1, but is currently trading for $1.04. With increased liquidity, thanks to chicken bonds, LUSD may start to trade closer to its dollar peg. Chicken bonds launched October 4th. So far, 203 people have participated, 80 have chickened out, and the remaining 123 have chickened in, according to data from Dune Analytics. According to Claude Donze, an investor in Liquity, the goal was for users to bond 10 million LUSDC in chicken bonds first month of operation. But it's on pace to triple that. Users have, so far, deposited $28 million worth of LUSDC, according to Dune Analytics. DeFi and crypto are in a tough spot. The multiple-digit yields in DeFi we've seen in previous cycles are gone because demands to borrow crypto and collect token incentives, the thing that fed those yields in the first place, has evaporated. Meanwhile, traditional finance is offering higher rates, making it harder for riskier platforms to compete. But there's that saying, necessity is the mother of invention. And crypto platforms and founders will be forced to innovate to deliver safer and more intuitive user experiences, use cases people can't get elsewhere, and, of course, competitive yields.